Kia ora, and welcome to the Cotality Property Market Update for Hongongoi, July 2026. The Aotearoa property market has continued to soften in recent months. Values fell by 0.2% in June and are now down 0.8% over the second quarter of the year. Tamaki Makaurau, Auckland, and Te Whanganui Atara, Wellington, recorded the largest falls, down 0.5% and 0.4% respectively. Ōtautahi Christchurch values rose 0.2% in June and are now up 3.0% over the past year. Tauranga and Ōtepoti Dunedin have had mixed results in recent months, but values are still higher than a year ago, up 1.2% and 2.1% respectively. For active buyers, there is still plenty of choice. That gives them bargaining power and is helping keep prices flat to falling across much of the country. Investor activity has also softened. Mortgaged multiple property owners accounted for 22.5% of sales in Q2, reversing some of the recovery we had seen as market conditions became slightly more attractive. Larger portfolio investors appear to have pulled back the most. That is understandable given uncertainty around tax policy ahead of the election, including the possibility of a more comprehensive capital gains tax and changes to mortgage interest deductibility. The latter could put further pressure on cash flow in an already tight market. Movers are also holding back, accounting for only 25.6% of sales. Within that group, the most cautious appear to be those who may have moved regions if the economic backdrop was stronger. Upgraders appear to be finding opportunities, perhaps helped by the narrowing price gap between 3 and 4 bedroom homes. Of course, the cautious attitude of other buyers has benefited first home buyers for a while now, and June's data further illustrated that. A record 28.3% of sales went to this group in Q2. Something for all buyers to be mindful of is flood risk. A recent Cotality analysis showed that properties affected by and at higher risk of flooding are generally cheaper, but have also seen more resilient value growth over time. Buyers appear to be accepting greater risk in the name of affordability. And that isn't necessarily a problem if appropriate insurance cover is in place. The concern is where buyers may ultimately be relying on a government backstop if large-scale flooding events become more common. The key focus over the past month was the Reserve Bank's latest monetary policy review. The decision itself may not have been a major surprise, but the tone of the committee was important, particularly after the split decision of the previous monetary policy statement. Below the surface, committee members weren't entirely aligned on inflation risks. Two members pointed more strongly to upside risks, while the others saw the risks as more balanced. Normally, that might make the bank more cautious, but with financial conditions already loosening, the committee appeared keen to push back against any further easing while medium-term inflation remains uncertain. That uncertainty is coming from several places. Specifically referenced in the review were geopolitical conflict, with the US-Iran peace deal remaining fragile, and uncertainty around the global economic recovery. Another uncertainty is where the so-called neutral interest rate actually sits. Structural changes to supply chains and higher defence spending globally have led some analysts to question whether neutral rates are higher than previously thought. In other words, a cash rate that once looked restrictive may now be closer to normal. Most importantly, while further OCR increases are on the cards, as the bank reaffirms their desire to get back to that neutral rate, the timing of those increases are far from certain and most certainly data dependent. Mortgage holders continue to favour longer-term fixed rates to guard against short-term uncertainty. For 6 consecutive months, around half of all new lending has been fixed for longer than a year, a stark contrast to much of 2025. Looking ahead, a lot of future expectations continue to depend on the tensions around Iran and the Strait of Hormuz. The recent reopening and lowering of oil prices globally gave hope that a return to normal might be within reach. However, the re-escalation of the conflict may have thrown all of those hopes into disarray. Predicting things in this environment is proving very difficult. We're keeping a close eye on any signs of second-round inflation, with upcoming labour market data likely to provide some of the clearest signals yet about where interest rates could head next. Stay up to date with all the latest movements at cotality.com/NZ. Follow Cotality NZ on social and subscribe to New Zealand Property Market Podcast on your preferred platform. Maha te wā.